Morning, ladies and gents. Simon Brown here. I'm going to be hosting, although I'll be doing a discussion today. I've got Michael Russo, Senior Investment Consultant from 10X Investments. We want to really dig into two things. And if you've got questions, please drop them in the Q&A box. We've certainly got time for it. We want to dig around fees, and certainly fees is a road that we've been down before, but it remains hugely important, and we will get some nuts and bolts around that, different fees. Also, the trend that we've been seeing in some financial products where fees have started edging higher, particularly in the platform space, which is, well, a fee's a fee. It doesn't matter where it comes from. Ultimately, you're paying it. We also we're going to talk more broadly about Reg 28 products. I think they've got some bad press. I will talk about my experience, which is why I think some of them have got some bad press. But as I say, if you've got questions, drop them in the box. Michael, appreciate your time today. Looking forward to the chat.
Yeah, Simon, pleasure to be here. Nice to have another chat with you.
I want to kick off, and I must stress that this is 1994, so we're going back 30 years. There quite possibly some people in this webcast who aren't even 30 because they're planning well in advance for their retirement. But my first RA that I bought 1994, I had just got my first sort of proper job. I'd moved to a new city. And my mother was like, "No, you've got to be responsible. You've got to go and get yourself a retirement product. I'm in my early 20s, and this is the best time to start." And she was right about all of that. And so her broker phoned me up. He worked for one of the big long-term insurers in South Africa. Sketched out. We did a plan, and the money started going off. And about, I don't know, it was about a decade later, I think, when Rob Risconi came out, Michael, with his sort of, I suppose it was an expose in a sense, or maybe it was just helping us understand the impact of fees on those products that had been sold in the early 90s, and I suppose all the way through the 90s and into the 2000s. Michael, it's not necessarily that they were horror products, but certainly they were a fee structure which we fortunately don't see today, but a fee structure which, in my personal case, absolutely destroyed any sort of value in the product.
Yeah, I was going to say it was a bit of the Wild West back then, but even this year, I mean, we got a quote from another investment provider, and it was sitting at a EAC of 26% year one. So that kind of stuff is still going on. It's still going on today. So yeah, I think it's very important for people to know the massive negative impact that a high fee can have over the long run. Because usually, I mean, a person sees 2-3% and they go, in relation to 100%, that doesn't seem like much, so they sign, right? But if you just quantify that over 20, 30, 40 years, I think you will be massively surprised by the negative impact. I mean, I'm talking 40 to 60% impact on the bottom line. So you can be 40, 60% off of your retirement goal by the time you get to retirement. So when you sort of researching retirement annuities or reviewing your retirement annuity, you really need to put fees up there in terms of one of the most important parts that you need to be investigating. And I think the first challenge is understanding the impact of fees. The second challenge is actually receiving 100% disclosure on those fees, because that's a whole nother ball game. There's so much vagueness, and it's like pulling teeth, just trying to get your total fee the way that a layman understands. And I always encourage investors to say, look, I understand what you're saying, but unfortunately, I can't guarantee the rest of the industry will understand what you're saying. So the best way that you can sort of protect yourself from non-disclosure of fees, and this is really, I have to encourage you to always remember this. When you want to know what total fees are, you need to use this investment term called EAC, effective annual cost. By asking for EAC, you are ensuring that you are going to receive 100% disclosure of not just your costs, right? So upfront fees, financial advice fees, admin platform fees, total expense ratio, investment management fees. There's a list of 15 potential layers of fees. It's going to be included in EAC. Yeah, a lot. So don't ask for itemized billing. You're going to miss one or two, and then you're not going to get full disclosure. What you instead, make your life easier. Just ask for EAC. And then there's a very important fact. There are some companies out there that are offering boosters, bonuses,
Yeah.
on top of all of that. And it just sort of creates a little bit extra complexity to the products. And by asking for EAC, your benefits are included in that. So EAC is actually showing you the net cost of your fees and the benefit. So where the mismarketing comes for these products is they'll say, oh, look, your EAC, yes, it starts off high, but it tapers off as you're in it for 10 years, 15, 20 years. So your fee comes down. And then where they go wrong is they say, and you get a booster bonus, etc. And unfortunately, that word "and" is where it's the misinterpretation, because your fees are actually coming down because of the effect of the booster, the bonus, not and you're getting a
Oh.
bonus on top of that.
Yeah. But I mean, I tried to get a fee schedule
Important.
probably the late 90s. And they were just like, we don't have a fee schedule. It was just like it wasn't even there. There's a lot there that you spoke about that I want to come back to. But one of them is, and I've seen a couple of these where there's a sort of a front loading of the fee for the first 3, 4, 5 years, perhaps. And I've seen, in the high 20s for year one. And folks will say, yeah, but it's just for year one. My flip side is year one is your most important year because it's the money that's going to be there the longest. And if you just gave away 26% of it, and you've been that's a gut punch. It is your most, year two is your second most important, year three is your third most important, and yet you're giving away a significant chunk. And it might not, you'd say, but I'm only paying, I don't know, whatever my monthly contribution is, annualize it out. But again, roll that 20, 30, 40 years into the future, you've just given away a huge amount of your retirement.
No, exactly. And, everyone loves to talk about how, compounding returns is the eighth wonder of the world. People need to know that fees also compound,
Yeah,
just
yeah,
negatively. So if it's
yeah.
at the start, that's going to compound negatively and have adverse effects on your end retirement goal. I mean, like if we were just to take a step back, right? Because the whole topic today is saying, look, most people, they have these RAs that are underperforming, and you speaking from experience saying, look, my RA, I could hone in and say, right, fees is the reason why. And obviously I explained now how you can receive 100% disclosure just by asking for EAC. But then what I realized is people also don't have a feel or a gauge in terms of, is this a good fee? Is this an average one? Is this a high fee? What is this? So maybe I can give investors just sort of a feel for the market, right?
Yeah, I mean, what is a fair fee?
So
Because I mean, to the point, we have to pay. I mean, no one's disputing that they're having to pay part, but that's a great point. I mean, what is a fair fee? Because someone out there is going to say, well, 3% seems reasonable.
yeah, and it's I'll give you the gauge, but then I'll also caveat that with a disclaimer, because I mean you've got low cost providers which offer
Hmm.
around 1% and less, right? So that is
Hmm.
low cost, giving you access to the markets. Then you have your medium cost providers. They're more in the 1.5 to 2 and a bit% in fees. And then you have your high cost providers, which is 3, 4, 5, up to 26% in fees. And so that's giving you the gauge. But the reason why I want to put a disclaimer in there, or caveat, is because sometimes a person can charge a high cost, so like a 2.5% fee, and justify it with value, with
Fair point.
the higher returns. So it's not the be all end all. It's just unfortunately there is a high correlation between high fees and underperformance. So you just need to make sure that when you're reviewing it, right, yes, here's this 2.5 fee. 2% fee, it's medium cost, but what are the returns as well in conjunction with that? Net returns, that's the key focus there. And I was chatting to a colleague earlier this morning, and we were just chatting about obviously 1 year returns, 3 year returns, 5, 7, 10. And something that I've realized is a lot of investors are fixed on just looking at 1 year returns and 3 year returns. And there's a bit of a flaw to that, because the portfolio managers, the way they position specifically retirement annuity portfolios, they position it to achieve success over 5 to 10 and longer investment horizon. So they're not really aiming to do well over 1-3 years. They're aiming for long-term consistent returns. So it's a bit like saying judging a long distance runner, a 10K, gold medalist on his 100-meter sprint time. That's not why you are investing in a retirement annuity.
100%, and I like the analogy. And I want to go back to your sort of low, medium, and high cost. It's also oftentimes there will be an advisor fee in there, and the question is then what that advisor does. And again, there's no perfect answer to it, but I know people who are paying an advisor fee and haven't seen their advisor in years and years and years. The inverse, people who are paying an advisor fee and the advisor is helping with estate planning and really sort of coming to the party. It is, in a sense, it depends on, again, it's not a perfect number. It's what are you getting for that money that you're spending? And far too many people, I think, are, they saw the advisor, they signed the documents, and then the individual kind of faded away with the recurring advisor fee.
Yeah, I think this is actually quite a tricky topic, because we firm believers that if you're going to be charging a financial advice fee, you need to link it to value. And, unfortunately, there are financial advisors out there that are adding immense value, right?
Yeah.
And are charging a fair fee, but then they are getting the rap for those advisors that aren't delivering on that value that people are paying them for. So yeah, it's a tricky one. Sometimes obviously financial advisors would get offended when an investor says, no, I don't need a financial advisor. When I've met a few that are worth their weight in gold, but I've also met a few where the value isn't there. And so it is a tricky one, and you got to use it case by case. But like I said, when you're evaluating the fees, you're looking at your net returns, and are you being successful in relation to that fee, that EAC that you're paying?
If someone's stuck in one of those very old school, very unpleasant products, such as I was, I moved mine. There was an exit fee that I was charged by the provider. I quickly ran the math that their long-term performance, and to be clear, their sort of 10-year return was below the market. In other words, passive was beating them. And two, just the saving on fees. There was a penalty to move the product into what I want to call a new age, a lower fee product. But running the math, it was well worth the move, because it means I'm richer in retirement, notwithstanding I at some point take a step down when I pay that penalty to exit.
Simon, that is spot on. I mean, that's a daily occurrence that I experience with investors, because what you'll find is we'll do this exercise called a comparison report, where we just compare a person's existing investment to our company, and just to see, right, can we put you in a positive position, right? And quite often we can put you in a more positive position, and then we look in terms of executing on the transfer, and then we find out that they've got a 15% penalty fee. And then you have to weigh up, okay, if I take a 15% penalty fee, how long is it going to take me to recoup this? And just to sort of, again, there's 3 sort of scenarios with penalty fees. So yes, you can transfer retirement annuities even before it matures or before your retirement age to another provider. But what is the penalty fee? So sometimes there's no penalty fees. Scenario 1, there is a penalty fee, and it's 150 Rand, 300 Rand. It's a small price to pay to improve your RA. Scenario 2, slightly larger pill to swallow, where let's say the difference in fees is like 2.5% and 1%. So you'd be saving on fees, on an annual basis, and your penalty fee is 4% or 2% of the total value. It's a big pill to swallow. Ouch. But it'll take you a year, 2 years, 3 years to recoup that, and then you're in the money every year thereafter for the rest of your life. And then you come to scenario 3, where I'm talking 10, 15 to 20% in penalty fees. That scenario, I mean, if the difference between your cost structure is 2.5 and 1, it's going to take you a decade to recoup that. I know in your case you were paying like 5% fees, so it would have been 2 years, 3 years, and then you've recouped, right? But nowadays it's a little bit closer than that, where there's a difference of 1.5% saving, and it's just going to take you a decade plus compounding. Sure. And so the person has to actually stay with the provider, which is unfortunate because the investor wants to hold their existing provider that's underperforming, wants to hold them accountable, but they can't because they're going to be the one fitting the bill. So yeah, shame. I really feel for investors in those situations, because it is one of those things where you just then, in those cases, what they do is they just make it paid up. All right, they just stop putting money down that hole, and they just start anew, and we call it school fees. You live and you learn.
Yeah. In my example, and I stress this with mine, I put a request in. I was told I was going to get a 30% fee, so I walked away, and I went back 6 months later, another request, another 30% fee, and I'm like, not paying that. And then I actually got someone to help, a friend who's in the industry, and he managed to get it down to a 12% fee. And at that point, as you say, I was paying 5%. I was moving to a 1% product. I was saving 4% a year. 12% is a horror number, but I was in the money by year 3. So I swallowed it. I absolutely took the hit. Something else, and I was writing about it recently in my newsletter. I mean, if I go back 20 years ago, there were fees all over the place. They were, in many cases, they were high. And even more if I go back into the 90s. My first brokerage account, I think my transaction fee was 2%. And now we can get 0.25% brokerage accounts for the JSE. My sense was we had sort of 20 years of fees coming down pretty much across the industry. And certainly I've seen some of them, and I mentioned in the intro, where in the last year or so, we're seeing fees maybe not go up, but new fees being brought in. The favorite seems to be suddenly the platform fee arriving, where you get an email from your provider and it's like, we're pleased to announce we're going to be charging you more. Is that fairly isolated? That just something I've spotted, or are you seeing some sort of new fees or increases of fees coming in on some existing products that are out already, or from existing providers?
Well, fortunately, I'm in a strong position to actually comment on that, because since I joined 10x, I was actually tasked of collating the data and comparing all the various funds. And through our comparison report exercise we do every day, we get a good feel of the market. So we've done thousands of these from all kinds of various providers. And I must admit, like at the start, about a couple years ago, there was quite a large gap between the low-cost providers, the medium-cost, and the high-cost providers, but it has started to narrow quite a bit over time. And these days, people were sort of reducing their fees, but there were a couple low-cost providers that sort of really went low in a business strategy where they were trying to leverage economies of scales and were banking on high inflows to sort of make up the initial loss. And unfortunately, those inflows didn't quite keep up with their projections, and then now they had to re-increase their costs. So I'd say there's been a handful of companies that have gone that business strategy route and then have had to revert. But I would say on the whole, I have noticed the costs coming down, but there's still room for improvement. There's still room for a lot of providers. Yeah.
And it does mean if you're someone who got one of those emails, maybe phone around a bit. Michael, we've been talking Reg 28 products, retirement annuities and the like, and the fees in particular. And anyone who's met me in the last 30 years has asked me about retirement annuities. I've sworn a whole lot like a like a sailor. But the point being is that they're actually a really, really excellent product. I mean, just the structure of it. I mean, small things like I can't get the money before 55. Okay, two-pot changes that. We'll park two-pot. We'll come to that in a moment. The tax advantages to it, etc. The Reg 28 is actually a really, really good piece of legislation that is really advantageous to long-term investors looking to save and invest for their retirement.
Yeah, I think there's two sort of questions in there. So the first one is obviously retirement annuities, good or bad, right? I can't tell you how many investors I've spoken to and I've said the words, I don't believe in a retirement annuity. And
Yeah.
partly because of experience like yours, the
Mhm.
underperforming investment, but also partly because there's a little bit of a gap in knowledge or the way that they perceive the RA's total return. They're not comparing that fairly. And that's kind of where they do an incorrect comparison, and then they form the opinion that, they don't believe in RA. So just to sort of expand on what I mean by that, right? So naturally, we've been chatting about high fees and how that destroys the underperforming. It creates an underperforming RA, right? And then you go and receive your, measly 7, 8, 9% return on your investment inside of the RA, and then you go and compare that to the S&P 500. And the returns that they're doing, and they're just going, why would I invest in the RA? Clearly, the S&P 500 is giving me much more returns. But that is sort of an incorrect comparison, because the reason why you use a retirement annuity, an RA, to save for retirement is because with the retirement annuity, there's not just an investment return, but if you're earning a taxable income and you contribute, there's a taxable return as well. So
Ah.
investment return and a tax return equals total return for an RA.
Mhm.
Whereas if you invest in your S&P 500 unit trust ETF or fixed deposit or whatever, there's no tax return. So if I were to illustrate through an example, let's say your RA is underperforming and it gave you 1% for the year, right? If you're a 31% tax earner, right, and you throw money into your RA, you're getting a 31% tax return and a 1% investment return. So together, your total return was 32% for the first year. Moving to the S&P 500, where the investment return was, let's say, 20% for the year, your RA still outperformed it that year. So that's sort of the unfair comparison that a lot of investors do, is they
Yeah.
remove the tax benefit and only compare the investment returns. So I think just framing it correctly and understanding like sort of the difference there. But then I get a sort of a analytical objection to that. They said, yes, I get a tax return now, but when I retire in the future, I'm going to land up paying tax on the money anyways.
Yeah.
And that's a valid objection. But to sort of respond to that, what you'll find is that when you're saving for retirement, you're not most of the time you're saving to replace 60-70% of your income. So
Mhm.
that means when you get to retirement, the marginal income tax that you're paying at retirement is most likely going to be lower than the marginal income tax rate that you got a tax return on at present. So there's a bit of a tax saving there. And then also, when you retire, you can take 550K tax-free out. And
Yeah.
you can withdraw up to 1/3 more. And there's a slightly favorable tax table there as well. And we're not even also finally speaking of the fact that your money is going into an RA and it's generating an investment return that is tax-free all the way till retirement. So it's growing a lot faster than if you put it into a normal investment vehicle where the returns are taxable. So it's just understanding like the framework and all that of right, RA, the total return compared to the total return that you get with other investment vehicles, and then just handling that the tax later versus tax return now sort of objection, just to clear that up a little bit.
Yeah.
Um,
I get your point, and particularly, I mean, because take the S&P. I mean, it's a stellar year, but if I now want to, I don't know, take some profit on my S&P because we've had a stellar year, we've had a stellar decade. I'm going to pay tax now, and it's a key benefit that the RA, the Reg 28, can manage that without incurring tax events for me. Even small things like dividends. I mean, I love me a dividend, but of course, 20% of it never gets to me. It just goes straight off to SARS, nice and simple. A lot of folks, Michael, they also Reg 28. We've got the tax benefit. We touched on that. There are then restrictions in terms of what? In terms of equity, REITs, cash, alternatives, and of course the big one is offshore. That offshore is now 45%. There isn't a single fund manager I've spoken to in the Reg 28 environment who's at the full 45%. Their view is, 45% is plenty, partly because you can buy Richmond on the JSE and it's actually a Swiss company, but it's considered local. Is the restrictions in terms of the offshore limits and the different asset classes a concern, or are we at the point now where actually the Treasury has given us enough latitude for investors?
I'm smiling because there's actually a bit of a story there, and I think once I tell the story, you'll start to understand Regulation 28 quite a bit. Right now, the current view of Regulation 28 has been sort of a negative view, saying, this is a rule or constraint. It holds me back. It holds my investment back, and I completely understand why, but let me explain how Regulation 28 came into being. So it obviously came into being in 2008. And the reason why they put these restraints in order was because offshore was severely underperforming for that decade. They literally called it the lost decade. And a lot of people had overexposed their life savings to 100% offshore, and it did so much damage to their investment. So the government stepped in and just thought, look, let's just take a parent decision here and just sort of force diversification. So they started putting sort of limits in terms of saying, please don't put 100% offshore. Based on the data that they had at that present time, 25% offshore was sort of the view based on that data. And with the lost decade in mind, they've just put a constraint on that. So in 2008, this rule came into being, and many people understood at that present time why this rule was put into place. However, unfortunately, offshore markets decided to boom from there onwards, and then it just started flipping the data. And a lot of people now looked at this as saying, why am I only allowed to put 25% in offshore? Look how well it's doing relative to local markets, which you're forcing me to invest more in. So there was a lot of pushback. And to the government's credit, they actually they did their Monte Carlo simulations to work out what is the optimal asset allocation across cash, bonds, property, shares. And then they worked out, okay, this needs to be adjusted, this 25%. So they adjusted it up to 30%. And then, unfortunately, offshore continued to grow substantially. And then they realized, look, we can't keep doing this adjustment every 5 years. So they adjusted it a little bit more than what the optimal asset allocation is. So they moved it up to 45%. And when they did that, all of a sudden, now the asset managers had more leeway to invest in more offshore, could invest up to 45, but believe it or not, the asset allocation based on present at that moment in time, it was like 2020 something, when they adjusted the rule, it actually didn't make sense to increase the offshore exposure because overseas was overvalued, and it's starting to sort of just be in the middle there in terms of relative to local stock market, and that's why portfolio managers haven't gone all the way there. So if you're wondering why is this regulation 28 in place, that's why. That's the whole history lesson. So sorry I dragged that out a little bit, but just gives context as to what this whole Reg 28 is and how did it come into be.
I wanted, folks, if you got questions, I'm not seeing any coming, but if you have got, one did come to me on Twitter. Michael, you mentioned boosters and bonuses and something, and someone's tweeted me, Kevin is the name, and Kevin is saying he's always just he wants the vanilla product. He's always worried that the boosters and bonuses and all those other fancy special things are almost trickery. It's like the buy one get one free. Why can't you just give me half price? And he just wants the straight, good old fashioned vanilla. And I got to say, I think it's a fair shout by him, because I look at both boosters and bonuses, and I just think that there's something happening there that I'm not fully understanding, and that's the whole plan of them.
Yeah, it's a tricky. Trying to think how to answer this. There's when it comes to these situations, right? You always want to ask yourself, look, what's the clean product from that company look like? How much does it cost? And then compare that to the more complex product and the bells and whistles. And then you will see that there's a bit of a difference or a bit of a gap. And then ask, why is there this gap? Also, on those quotes that you're receiving for those contracts where they're adding these sort of extra benefits on, they do stipulate the exact sort of impact that this has on your investment. The problem is most people, I mean, this is not their job. They're specialists in their own role, and now they're coming into this area. And I always feel for investors, because if you put me in a hospital and ask me to try and do something, I'm going to make a mess. I don't know what to do. But fortunately, nobody is put in a position like that. But you have almost everyone is put in a position where they have to make an investment decision, but they didn't study this, so now they have to resort to other people to obviously help them with that. And they receive these 40-page quotes that you need a lawyer to try and get through. And it really is a tough one. But just be very careful about when somebody's offering you free money. Stick to your life lessons, saying that there's no such thing as a free lunch, and then just query, because ultimately companies, all investment companies, are there to create a profit for their shareholders.
Sure.
And how are they going to make a profit? By giving money away. So I think we've reached the limit of
I like your point, which is go find the vanilla version, and it gives you comparison. Kevin's come back with a second question. He says he's quite young. He's got a Reg 28 going. He says, is there an ideal percentage for what you should be saving every month, depending on your current age group? I mean, if you're in your 30s or 20s, or I mean, are there sort of it's not going to be ideal because there's so many moving parts, but perhaps a sort of a theoretical, in your 30s, it should be 15%, or in your 20s, it should be 18%. Is there some sort of guideline around that?
Yeah, so there's a two-part to this question. So you got different cohorts, people on different life stages, right? So in this instance, I'll answer the question for like a 20-year-old, right? But I also want to answer for like a 50-year-old, because they'll have a different answer to that. So to start off with the 20-year-old, 30-year-olds, when it comes to saving towards your retirement goal, the way you want to perceive retirement vehicles like pension funds, provident funds, and retirement annuities is you've obviously got this time from now till retirement to save. And because of the compounding effect of your contributions and your investment, you're actually outsourcing a lot of the work to the market and to SARS. So for every contribution that you put towards a retirement annuity, let's say you're looking to save 10 million at retirement, just a random number, right? Over your lifetime from 20 till then, you'll probably only have to put in a million, 1.5 million. And then because of the tax return SARS is going to give you, SARS is going to come up with another million for you, or $1.5 million.
Yeah.
And then the market is going to compound and come up with the rest. So you're really making your life easy if you start early, because you're basically outsourcing your hard work to the markets and to SARS. So they're all contributing more towards your retirement savings than you are. Whereas if you leave it to like 30, 40, now all of a sudden, you need to contribute maybe 3 million of that 10.
Mm-hmm.
SARS is going to come up with only $1 million of that, and then the market's going to come up with the rest. So you have to do twice as much work or more of the work to get closer to achieving your retirement goal. And then when you leave it till age 50, unfortunately, you now have to do all of the work. So like 60, 70, 80% is your contributions. SARS a little bit of the work, and then obviously the markets to compound. So the really smart thing to do is actually to outsource at a young age, because then you really can, and I'm going to live your best life for the next 30, 40 years. I often hear that. So that's the one answer for your 20-year-old, right? So, and just to be a little bit more specific, there's no exact percentage. You have to use a calculator because everybody's got a different retirement goal. Some are looking to replace 60% of the income, some 80%. So unfortunately, there isn't a golden rule, but generally 10, 15% is the average that most 20-year-olds contribute and allow to compound. And actually, just to add one nice little sort of example of the compounding effect, just to really drive home starting early before I answer the 50-year-old, there's a tale of twins. So Jack and Jill. Jack starts saving towards retirement, 1,000 Rand a month from age 20 to age 30, and then stops. So every month, 1,000 Rand a month from 20 to 30, and then stops. And then retires at age 65. Then you've got Jill, who doesn't start at 20, only starts contributing 1,000 Rand per month at age 30, but continues every month from age 30 all the way to age 65. Believe it or not, Jack has more money at age 65 than Jill. So make your life easier. Outsource that work to the markets and to SARS. And then the 50-year-old, just to answer, Shame, I got a question from an investor. He said, is it really worthwhile? I've got 8 years left till retirement. Does it even make sense for me to contribute towards a retirement annuity? And a lot of people get into that phase of their life where they feel, I haven't saved enough, and they get a little bit of financial fatigue, and they just feel, I don't think I'm going to be able to save enough, and then they almost give up. When actually over that 8-year period, I showed him, I said, look, if you contribute, and you obviously you got to make tough calls at that moment in time, but if you can really bite the bullet and contribute towards your retirement savings a lot, SARS is going to give you a lot, and the markets is going to help compound that. And over an 8-year period, you might be able to actually 8, 9, 10-year period, you can double your money if you invest it correctly. So don't worry, you can still make a major impact to your retirement savings and achieve or get very close to your retirement goal. So don't give up if you feel I'm 8 years out and I don't have enough. You do the numbers, invest correctly, outsource some of the work to the markets and to SARS, and really just pull the team together to help you achieve that retirement goal of yours.
I say it all the time. Every February we get the budget. Money gets, we pay money to as tax left, right, and center. We get a few little benefits back. One of them is the Reg 28. I think it's age irrelevant almost, in a sense. If there's a benefit there, you should be grabbing it, even if you're old. I met someone last year at an event. He was, I think, 70. He was in his mid 70s, and he had a tax problem, which is a lovely thing to have in your mid 70s. He was paying too much tax from his living annuities. So he opened a new Reg 28 to reduce his tax. And he said, I don't know what I'm going to, it was just for him, it was a way to help with the tax. I want to start to wrap up. I want to quickly go back to Two-Pot. Finally arrived last year. Initially, there was a potential of up to 30,000 for an individual to withdraw. There were some T's and C's. There was, of course, tax to pay. And if you had any arrears, SARS wanted that as well. Michael, what's the status now? I mean, as I understand, new contributions, am I able to withdraw those? Are there frequency limits? What's the Two-Pot story at this point in time, now that we've passed that sort of initial start date?
Yeah, so I think I'll explain going forward how it works, and then I'll explain obviously 1 September 2024.
Yeah.
So just for everyone, the way two-part works is when you contribute towards retirement savings, it splits your retirement savings up. 2/3 goes to a retirement pot, 1/3
Hmm.
goes to a savings pot. And the reason why the government brought this into place was because prior to 1 September, if you were to contribute towards a retirement annuity, you had no access to the funds. So when a crisis comes around, like a COVID, you
Hmm.
have, and you need the capital for whatever reason it may be, in a desperate situation like that, you've got this money sitting in a retirement annuity, and you just unfortunately don't have access to it. But, yes, great to save for the future and for retirement, but I need to get past today. So
Yeah.
that's where the government just sort of intervened and said, look, let's make a rule change here, and we'll give people access to the savings pot. So in other words, if you're contributing 3,000 Rand a month, 2,000 Rand is going to the retirement pot, 1,000 Rand is going to the savings pot, and you can access that savings pot. But there is a consequence, because remember, when you contribute towards retirement, you can
Hmm.
claim a tax return, right?
Hmm.
If you access that savings pot, then you have to give the tax back. So you're going to
Yeah.
be taxed at your marginal income tax rate. So sometimes, depending on how much money you're taking out, it might push you up into a higher tax bracket, and you'll end up actually
Oh,
paying
of
more
course.
tax than you got. So you have to keep that in mind when you accessing. And this is, remember, the government's obviously saying, look, this is for extreme circumstances.
Yeah.
And in extreme circumstances, you would be very happy to pay that price to access. Um, Before I get to the 1 September part, the rollover, what you'll also find is some investors, and Simon actually brought this up before, how some investors think, oh, because it's in a savings pot, it's in
Ah,
a savings
in
account
cash.
generating an interest. Yeah, in cash. No. If you own like a balanced fund, for example, both the retirement pot and the savings pot are invested in that. It's the only difference is they're just saying this is how much you have access to
Yeah.
in the savings pot. The other two, unfortunately, that goes on to retirement. And then just to address the 1 September 2024, so some people have already been saving in a retirement annuity for a couple of years, so they already have a lump sum. So in that instance, people said, well, look, I'd also like access to that money. So the government put the rule in place where they said, okay, let's say you've got 300,000 saved up in your retirement annuity. Now, 10% of that can roll over into your savings pot. So if you've got 300, 270 will be moved into the retirement pot, and
Hmm.
then 10%, 30,000 would go into the savings pot. But if you had 400,000, then it's capped at 30. So not 40,000
Gotcha.
will roll over into the savings pot. And that's just one off. It doesn't happen every year that it gets split and pushed into the savings. No, it's purely just 10% up to 30,000 goes into the savings pot, and that's it. Every new contribution you put in there tops up the savings pot from there onwards, and then the rest goes into the retirement savings pot. So that's just clearing up the rollover for 1
Yeah,
September.
I got you, and I got to say, I thought it was a good move. I mean, people have quit jobs to access and their retirement annuity because of crises in life, and I think as we sort of roll forward in 5, 10, 15 years time, I think it's going to be a strong feature of the product. I want to wrap up, and I really want to go back. I mean, we've talked a lot today, this morning. The fees has been a part of it. Effective annual cost, Michael, that is the number. You said earlier, just ask them for that. That is the be all and end all. Don't try and be clever and say, send me all the fees, or what about this? The EAC is going to be the number that will tell you what you're paying. That is what you compare. Then you've got apples with apples.
Yeah, exactly. So the whole point of this webinar is just to say, look, I've got an underperforming expensive RA. How can I fix it? And what we've been trying to do is just sort of recalibrate people's opinions with factual information. So starting from the top, the retirement annuity vehicle, why am I using that? Like to use save for retirement, why not another investment vehicle? Now it's because of the total return, investment return and tax return. So when you're doing your comparisons, keep that in mind. And then we zoned into the investment return. We're going, why is that so low? And we touched on, well, you could be receiving a good return, but then you unfortunately paying a very high fee, and that's turning it into a mediocre one. So you want to find out, right, what is my fee? And you find that out by asking for EAC, effective annual cost. By asking for that, you get 100% disclosure. And then you can see, okay, I'm actually paying quite a high fee, and the returns relative to everybody else isn't justifying that higher fee. Now I need to make adjustments. And just to add one last point to that investment return part, because we also touched on Regulation 28 on how it forces to diversify. There's an important topic there because people need to know that where does this, I give my money to the portfolio manager, where does he put it? He spreads it out across cash, bonds, property, and shares, right?
Yeah.
So those are the 4 areas that you can put it in. If you put 100% into cash and bonds, those assets or those types of investments are generally characterized by single-digit growth over the long run. There's periods where it's above and below, but generally single-digit growth. So if you're looking at your RA and you're saying, this is an underperforming RA, and you're receiving single-digit growth, and I take a look and I see you 100% in cash and bonds, yes, you were always going to get that. You because of your positioning, you didn't set yourself up for success. And then you've got obviously the property and shares. If you go 100% property and shares, you're going to get so much volatility in your portfolio. You're running quite a high risk there, but the potential of double-digit growth is high. So what you want to do is you want to make sure that you're positioning your investment not too aggressively, not too conservatively, somewhere in the middle where you build for the long term, and that is how you position your investment correctly.
Yeah, and I think the final point, and we've touched on it before, remember that at retirement, you've potentially got, 20, 30, 40 years of living. I was always taught, going back into the 80s, that when you got to retirement, you went into cash and bonds. And that's because, back then your retirement was, life expectancy was, 10 years. You've literally got decades now. You can still want that market risk because you want that market return.
I do see that quite often. A lot of people start to gear down. So for those that are 60 to 65 in that range, you'll see a lot of people start to gear down in terms of reducing their stock market exposure and increasing cash bonds. And I do understand that if you want to have a little bit more stable capital so that when you get to retirement, right, you then convert it to, let's say, a guaranteed life annuity, which is a product for post-retirement, right? But there's also another option like a living annuity where when you get to retirement, you can shift it into a living annuity where it continues to invest for 20 years. So by gearing down, if I use an analogy, if you're driving from Cape Town to Johannesburg and you are, let's say, just past Bloemfontein, and you're trying to get to Joburg, you're not going to gear down. You still got a good while to go. So definitely stay in your long-term investment. And I really do like the point that you made where you just said, look, people often don't realize that retirement annuities are not limited to age 18 to 65. No, you can be a 60, 70, 80-year-old contributing towards a retirement annuity. Why? Because you can claim a tax return if you're receiving taxable income.
Yeah, and get the benefit of that. We'll leave it there. Michael Russo, Senior Investment Consultant at 10X Investments. Always appreciate chatting. I always appreciate to get my horror story off the chest. I've done it many times. I will probably do it again. It is let me be the one who took the pain. And the key lesson, ladies and gents out there today, is it's fees. It's understand the product, and yes, there's tax advantages, and they all matter, and all of those things are important, and who your provider is, but the fees hurt. And as Michael said, it can take around half of your retirement away if you don't manage those fees. If you think you're in a horrible product, have a look at switching. You can run the numbers. As I said, I ran my numbers, and suddenly a 12% penalty, which was a horror number, but a 12% penalty was actually, I got it back within 3 years. So it's about numbers. It's about that EAC. That is absolutely what matters. Everyone here today, appreciate your time. Michael, thanks very much. I enjoyed.
Thanks, Simon.
Cheers all.